The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Friday the 22nd, 30 to the close. What do you need to know out of Europe? UK break-evens hitting a 25-year high. The Bank of England's new chief economist warning that inflation could hit 5%, warning that November is a live meeting. Germany's case count climbs sharply. Today has seen the biggest one-day jump in 5 months. We'll talk about that in just a moment. And Russia delivers a surprise 75 basis point hike, sending the ruble sharply higher. Let's take a look at where we are with equity markets, actually fairly flat on the week. Some up, some down across Europe. On the day, though, the stock 600 is up by 0.6%. We're watching what is happening in Russia. It's an indication, perhaps, what other central banks are going to be doing. In a moment, we'll hear from the SARB, head of the SARB, the South African Central Bank. Maybe he's next in terms of raising rates. But the US ruble crosses, you can see, the dollar down by 1.15%. Taylor.
Yeah, Guy, let's take a look at where we are within the U.S. here, because we were looking at some of the record highs here, but of course we're coming unch on the day, 45.50. You're up, I guess, less than 1 point, of course, on in terms of the S&P 500. The NASDAQ, we're coming off a little bit of the gains that we had yesterday. Why? Because Snap, and Guy, we talked a lot about this the last hour. 23% drop, one of the worst drops you've had ever for the stock. How much of this is supply chain issues? How much of this was management previously saying the Apple iOS system wasn't a big deal? Apparently, it's a huge deal, and we're totally all caught off guard. And you mentioned inflation, and Guy, maybe I'll punt it back to you on this. Our 5-year yields, they're coming down, but at 120, we're still the highest going back since February of 2020. It is our 5-year, our 10-year inflation break-evens. The two are rising to 15-year highs.
Yep, it feels very similar over here as well. In some ways, the narrative in the US and the UK feel very, very equal. Little differences. Energy is probably one of the main ones, but the cost of hedging against inflation in the UK over the next decade rising to the highest level in 25 years. This, of course, thanks to rising concern over those price pressures. We've had an interview in the Financial Times as well with the new chief economist over at the Bank of England. He's talking about inflation at 5%. He's talking about November being a live meeting, but he's not talking about a particularly aggressive rate path. Doesn't see rates needing to go restrictive just yet. Lizzie Burden, Bloomberg UK economy reporter, joining us now. The acceleration in this narrative has been dizzying. Lizzie, where do we go next? The new chief economist is talking about 5% inflation. The market's not even there yet, but it's getting there pretty quickly.
Yeah, Hugh Pill, thought to be a hawkish member of the Monetary Policy Committee. He does warn that inflation could reach 5% this year, but he also nuanced that narrative. He said that the meeting will be finely balanced. He said that there'll be a lot of disagreement on the committee. So we know that there are more dovish members who are still concerned about choking off the recovery. But his concerns come after the inflation data this week. It was below economists' forecasts, but still significantly above the Bank of England's 2% target. It was 3.1% in September. That'll weigh on household incomes at a time when the government's cutting benefits, raising taxes, and it also creates a bit of a headache for the Chancellor of the Exchequer, Rishi Sunak. He's got his budget next week, and he's going to be very wary of adding to these inflationary pressures when by injecting more government spending. He's not going to want to trigger an even more aggressive response from the Bank of England, because that'll only add to the cost of servicing the government debt.
Thank you, as always. Bloomberg's Lizzie Burden. Meanwhile, Guy, we're going to stick in your neck of the woods as well. Germany, as you mentioned, recording its steepest one-day increase in new COVID cases in more than 5 months. That is raising concerns about another winter surge. Here with more, Naomi Kresge, Bloomberg European healthcare and pharma reporter. Naomi, what are we hearing about the rise in cases?
So in Germany, as we've seen in other places in the world, these hotspots do correlate with places where vaccine rates are lower. You can see it in Germany. Some of the states with the highest case rates now are places with lower vaccine coverage than other places in the country. You can see it in Eastern Europe, with tremendous surges, not only in cases, but also in hospitalizations and deaths, and where we're also now starting to see a beginning of a tick up in vaccination in some of those Eastern European countries because people are seeing the results of not getting vaccinated for COVID.
Naomi, we'll leave it there. Thank you for the update. Naomi Koreski joining us on the COVID story, which, like the inflation story, seems to be re-accelerating a little bit in key areas. It's day 2 of the EU Leaders Summit in Brussels. One of the top issues, not COVID, but the energy crunch. The European Commission President, Ursula von der Leyen, addressing the crisis a few minutes ago.
We need a stable source, nuclear, and during the transition, of course, natural gas. And this is why, as we've already stated as a Commission in April, we will come forward with our taxonomy proposal.
Okay, Poland and energy dominating the story in Brussels. Maria Tadeo there for us. Maria, bring us the latest.
Yes, Guy, you know, this has been a summit very much focused on energy. It is true that on paper, not a lot changed today, but it's interesting, as you played in that clip, the head of the European Commission now actively saying we will explore strategic energy gas reserves, and we will also explore joint procurement. This was something that for the French President Emmanuel Macron, but also countries like Italy and Spain, was key to signal that there is a European response to this energy crisis. By the way, today, President Macron was also very vocal in saying clearly we want to move away from fossil fuels into a green transition. We want to double down on that, but we need to keep in mind there is a paid transition, and that will be nuclear and gas. So insisting on that point of nuclear will have to be in that transition phase.
Bloomberg's Maria Tadeo. Really appreciate it. In the meantime, we want to head right now to a virtual conference being chaired by Bloomberg's Francine Lacqua. She's joined right now by Federal Reserve Chair Jerome Powell. Take a listen.
Economy return to more levels of activity. However, it's a very uneven recovery. That's partly vaccine, it's partly policy, as Augustine pointed out, and emerging markets are well behind advanced economies. The key factor globally continues to be getting past the pandemic. The Delta variant forced a number of countries to re-implement restrictions, which slowed the recovery and further interrupted global supply chains. Those are diminishing now, but as economies reopen, supply bottlenecks are still weighing on production industries and boost prices, contributing to that higher inflation. So as the Delta cases line, we do expect prices to speed up, although we can't rule out the possibility of another spike this winter. In the U.S., it's a similar story. Very strong demand this year, tracked 5% growth. Like else, Delta variant temporarily slowed the economy's progress in the third quarter, keeping people from resuming public activity and in some cases turning to work. Growth slowed sharply. Q3 GDP is coming lower than we thought. So as the wave passes, my expectation is that job growth moves back up to the high levels we saw last summer, and the reopening of the sector continues. That may be slower and longer than we thought. Meanwhile, bottlenecks and tangled supply lines holding back activities in some, particularly automotive, and the combination of strong demand for goods bottleneck has meant that overall inflation is running well on target, even though inflation for services is not unusually high. So to your question, higher inflation. Our view has been that these first are likely to abate. The ones mentioned are likely to abate as the pandemic subsides, as spending rotates from goods services, as people go back to work, and as the constraints are resolved. Of course, our tools don't do much on supply constraints, and as obvious, I assume it's very difficult to predict the occurrence of supply constraints, supply side constraints, or how long they will take to it. And in fact, lately, rather than moving, supply side constraints have actually gotten worse in some cases. So we've also had labor issues, and now we're getting upward pressure on energy. So where does that leave us? So I think in these and in other advanced economies, with supply constraints and shortages, therefore elevated inflation, they're likely to last longer than previously expected, likely well into next year. And the same is true for pressure on wages. But it is still most likely case that as supply side constraints abate, as they eventually will, and as job gains move back up, inflation will move back down closer to our 2% goal. In the meantime, the risk is that when high inflation will begin to lead price and wage setters to expect unduly high rates of inflation in the future. And if we were to see a serious risk of inflation moving persistently to higher levels, we would certainly use ours to preserve price stability while also taking into account the implication of our maximum employment goal. We therefore need to make sure that our policy is positioned to address the full range of plausible outcomes. We'll be watchfully to see whether the economy is evolving and with expectations, and our policies will need to adapt accordingly. We are on track to begin a taper over of our asset purchases that, if the economy evolves broadly as expected, will be completed by the middle of next year.
Thank you so much, Chair Powell. Governor Cañago, you've warned of upside risk to inflation outlook. Is this an adjustment of supply to the changes in patterns because of the pandemic, or is it something that could actually stay in the longer term?
Thank you, Francine, for facilitating this, and thanks for Jay and Augustine for joining the panel. I think that from an emerging market perspective, getting into the pandemic, what we didn't have is the problem that the developed economies had, which were struggling to get inflation up. And yes, you had the COVID shock, and in the midst of the COVID shock, what you then had was that there was a shock to the inflation, and many emerging market economies found themselves with fairly low inflation during the shock. As the economies were opening up and vaccinations were taking place in the developed world, you saw that economic activity was resurging, and coming out of the lockdowns, those supply constraints started to be binding. When inflation started to rise in the developed world, it looked like the emerging markets, this was not about to happen, but it was a matter of time before it caught up. Because if these constraints were in the global supply chains, these prices will eventually transmit. And as the situation stands now with what is happening with energy prices, what is happening with the food prices, you are going to see that inflation is going to go up. And for the emerging markets, though, is that this might be combined with a depreciation of currencies. And when you have that with a depreciation of currencies, then inflation could be going up. And of course, the other is that as the developed world normalizes policy, there is bound to be a realignment of exchange rates, and there is got to be a repricing of financial assets. And all of those are also going to fit themselves into the inflation outlook. The policy response, naturally, is that you see through those shocks, which means that a judgment about whether the issue is transitory and whether there is persistence becomes important. And that is where judgment comes in, and you take it from there. The judgment at the moment is that it is transitory. And should we see any sign of persistence, policy is bound to respond to that.
Mr. Carstens, if you look at some of the economic conditions and the outlook in general, is it definitely improving? If you leave inflation to one side, even as we're going to the winter months, is it improving?
Yes, definitely. I think it's improving. I think that we are building up on the different signs of strength that have been out there since the middle of last year. I think one positive aspect is that financial markets have been working well. I think that the performance of market has stabilized. Another very important sign is that in many latitudes, we have seen that the corporate sector has been quite strong. In many places, the earnings of some corporations have been strong. A fear that we had last year was precisely that we were going to have a liquidity problem and then a solvency problem, which meant that there was the possibility of firms to go into bankruptcy, but we really haven't seen that. And also we have seen very strong demand performance, as some of my colleagues have said. So far, I think so good. I think that what we need to focus in now or in the months and years to come is that we need to understand much better how aggregate supply works, and in some cases try to identify what could we do to make the global economy less prone to this type of supply shocks. I think we have done a very good job in terms of managing aggregate demand, mostly through fiscal and monetary policy. but more work needs to be done in terms of aggregate supply. And I would add to that the necessity to preserve open borders and to preserve free trade, because I think that it's essential that goods and services flow well in the global economy.
Thank you so much. Chair Powell, I want to ask about the outlook for policy, but I also want to make sure that your connection is crystal clear, because we had a couple of issues in the last couple of minutes. But you said last month that the process of scaling back the Fed's asset purchases could begin as early as your meeting in early November. Since then, the data has been a little bit mixed, with the employment report for September coming in weaker than expected. So do you feel that the taper threshold has actually been met for the next meeting, or do you still need more time to assess how the economy is actually coping with the Delta variant?
So I said, I guess as you had an audio and maybe didn't hear, I think that we are on track to begin April of our asset purchase. And if the economy as expected will be completed by the middle of next year, and that means that for substantial further progress toward both of our goals, maximum employment and price stability, will have been.
Yep. Chair Powell, I think we need to reconnect with you. I understood what you said, which is you're on track, but we'll reestablish the connection and get back to you very shortly. Governor Caneago, how should central banks actually respond to the inflation outlook? Is there a risk at the moment of really falling behind the curve?
That is a possibility, but we got to make judgment. And we have so far done pretty well. And I think that we must accept that policy is executed in a very uncertain environment. And as things stand, our take is that our stance is appropriate for the current environment that we are having and given the outlook. But there are risks on the horizons. And in our previous policy meeting, we spelled out those risks, and those risks have to do with energy prices. They have to do with some domestic factors, which has to do with the pricing by utilities, and they have to do with the risks to the realignment of exchange rates and what could actually happen with exchange rates. And if all of those things combine together, you are going to have a serious problem of inflation actually materializing. Should there be a risk that the rise in inflation is persistent and not transitory, there is no question that a policy will have to adjust. Whether you are behind or ahead of the curve is always going to be a judgment call. It's never an easy thing to do. But what you can't do is to act preemptively or hastily in a manner that chokes the nascent economic recovery. But that said, we must also be cognizant that if the rise in inflation brings persistence, it's important that policymakers act with resolve.
So, Mr. Carstens, what could be the consequences actually if central banks fall behind the curve? So I think you're on mute. Perfect.
Hello. Do you listen to me?
Yes, we can hear you now.
Can you? Excellent. Yeah. No, first of all, I don't think that central banks will fall behind the curve. I think it's something that in the recent months, markets and many analysts have forgotten is that the track record of central banks in terms of fighting and preserving inflation has been very, very good. This is a very important comment in the light of this fora where we are talking about the South African Reserve Bank 100th anniversary. I think if there is a country that exemplifies how successful can be the fight against inflation, is what the South African Reserve Bank has done. They have been very successful at anchoring inflation through inflation targeting and so on. And as you have heard from Lesetja, they're pretty much on top of the issues.
Okay, we've been experiencing a few technical difficulties as we've watched what is happening at this event. We hope that they're going to be fixed very shortly, and if so, we may dip back in. But for the time being, if you want to continue to follow what is happening, you can do so on your Bloomberg terminal. All you've got to do, and it's fairly straightforward, is hit Live Go, and that'll take you straight back to what is happening here. Let me just recap, though, what has been said, in particular by the Fed Chair, Jay Powell. I appreciate that it was very hard to hear exactly what he was saying, Taylor. It's maybe hard to hear what I'm saying. But basically what he's saying is that we are on track to taper asset purchases. He says that that is likely to be completed by mid-2022. And he's also indicating that he feels that supply constraints will likely linger well into 2022. That is not at odds with this idea that we are seeing transitory inflation, which is the language the Fed continues to use. But nevertheless, certainly talking about that transitory period, maybe lasting a little bit longer.
And it's interesting, when you think about transitory, I've had a lot of debate about it doesn't mean that prices are going to come back down to where they were a few months ago. It just means that we're going to level out at these new higher rates, and we just won't increase at the same high rates that we've been increasing. So that might not square with some of the definitions of what other people are thinking about when they say transitory.
Well, the real question here is this going to be a prolonged period of increasing prices, or as you say, is this a readjustment in which we are going to see basically a series of price shocks and then we basically stabilize at those higher prices? Or do the prices just continue to increase? And that's the bit we don't really know yet. And what is clear is that this phase is lasting a lot longer. We heard from Chris Williamson at the top of the last hour from Market, going through the PMI data, that it is certainly going to last well into next year. And Jay Powell's talking about that as well.
You know, it's interesting. It was Raphael Bostic, and I'm going to credit our own Romaine Bostic for pointing this out. He's saying of the Atlanta Fed, we're going to call it episodic. We're not going to call it transitory anymore. So maybe we'll pivot to that word if it fits the narrative.
Well, I'm certainly keen to increase the vocabulary around all of this. I think what we want to avoid is the word persistent. No, I'm sick of transitory. Episodic, I'm perfectly happy to move on to. But what I don't want to get to, and I think what the market is worried about, is that ultimately this becomes persistent. And if we continue to see the price rises, and I think the other interesting thing as well about all of this is that while we may see initially this being focused in the material segment, i.e. energy prices and goods prices going up, does that then translate into labor prices, i.e. do we get a migration from kind of first round effects to second round effects? And again, I think everybody's on tenterhooks waiting to see whether or not that happens.
And Guy, just to pull it back to the markets, we're taking a look at a NASDAQ. We're off now 0.809%. Now look, at least within the S&P, we're at record highs yesterday. So nothing to panic about, but you do wonder when the markets start to digest perhaps maybe this narrative that it is higher than longer, though we increasingly hear from our markets guests, equities are the place to be in this rising inflationary environment. It's not Bitcoin yet, Guy, or is it?
Oh, maybe we're all getting on that train. It could be broader than that. But I think as well, today is an interesting day in as much as maybe this supply chain story is actually getting into the tech sector. We saw what happened with Snap. The NASDAQ, as you say, down by 0.9%. This is Bloomberg. So we're wrapping up the week here in Europe, actually on the front foot, on a positive note. European equities generally a little bit higher, as you can see. We're not up by much, but we are a little bit higher, as you can see. FTSE's up by 0.3%. The DAX is up by 0.5%. Conti's having a good day there. The CAC 40 is actually outperforming today. L'Oreal having a really solid session. We'll talk about what it's doing in just a moment. But that company certainly delivering some really strong performances and a real rejig in terms of the way it pursues growth geographically that is working right now. So that's the picture broadly. Let's talk about what has happened over the last 5 days for European stocks, just to give you an idea. To be honest, fairly flat. We finished the week on a positive note, as you could see. We've been climbing throughout most of midweek, but we're not up by much. But we are very, very close to record highs, which are around 475. We're at 472 on the Stock 600. So this grind higher continues on both sides of the Atlantic. Today, what are we seeing? We're seeing tech outperforming, which is interesting in the light of what we're seeing over in the United States. Taylor, what is happening here is that I think European semi-stocks are reacting to the Intel numbers, particularly Intel's production plans. So Nordic Semi and a whole range of other stocks are doing well on the back of that. So there's technology, as you can see, that's the one-day performance here. Luxury's bouncing back quite nicely. Chemicals are up, real estate's up. Industrials are trading higher as well. Where are we seeing weakness? Energy prices just dipping a little bit, down by around 0.5%. The sector is now performing a little bit off the pace, but generally this has been a very strong performance recently from that particular part of the market. So let's talk about L'Oreal, the driver of the French market today, up by 5.32%. The numbers came out late last night. The real story here, as I say, is just how they've managed to rejig things, kind of away from China towards other areas that are generating growth. So they're seeing really solid performances. The market likes that. That's why the luxury sector is outperforming. London Stock Exchange Group, we talked about the fact that the supply chain story is reaching into areas that you wouldn't necessarily think that it would. We talked about Snap a little bit earlier on. The London Stock Exchange is another example of this. The London Stock Exchange is struggling to update its IT equipment. It's struggling with technology because it can't buy it quickly enough. It can't get what it needs in terms of making the upgrades that it needs to be delivering. And as a result of which, stock's down by 5.52%. Conti's an interesting one. This is a major tier one supplier into the German auto industry and actually downgraded its numbers today. Again, yeah, you're getting a theme here, Taylor, on the sort of chip shortage, supply chain shortages that we're experiencing here. The sense seems to be that actually it could have been worse. The stock was up a little bit more, a little bit earlier, but still up by 0.9%. Taylor.
Yeah, really interesting, Guy. I want to bring you, as you're talking about the markets, folding into, more headlines that we are getting. Powell, of course, as we know from that virtual conference that Francine is hosting, Jay Powell saying that they are monitoring inflation very carefully and they will adapt accordingly. They said that they would use tools if we saw a serious risk of inflation. And Powell saying it is time to taper, but not time to raise rates, reiterating, I do think it is time to taper. The risks have clearly tilted to bottlenecks and higher inflation, but the global supply chain will resume functioning over time. So you wonder if this is a little bit of an acknowledgement, Guy, that they do see that the risk has tilted clearly to higher inflation, clearly to bottlenecks that have not eased up, perhaps maybe the way they thought they were. And indeed, you have equities reacting.
So there's a couple of things to say about this, one of which is it is clear now that it is lasting longer than anticipated. I think that debate is done. It is over. We are moving on from it. I think what is interesting here as well is market pricing versus what the Fed is saying. So Powell, in his conversation with Francine, is talking about this idea that we are going to crack on with the taper, but we're going to be done with that by midway through next year. You take a look at what is happening in the swaps market, Taylor, and basically there is now a 70% chance of a June 2022 Fed hike. So the gap between them finishing the taper midway through next year and starting rate hikes, there was meant to be a gap there. There was meant to be this idea that these are two separate processes. Maybe that's not actually going to be turning out to be the case. Maybe what we end up with here is, finish the taper, crack straight on with the rate hikes. And you saw yesterday traders for the first time pricing in 2 rate hikes by the end of next year, Guy, to your point, more than just one. And this is something that they've been trying to pursue in their communication very, very sort of strongly, i.e. taper is not tightening, taper is not tightening. But it looks like those two processes could ultimately just end up being on a continuum. And that's interesting because the market, therefore, will find itself in a position where it has to sort of think about the fact that maybe those two things actually become more blurred. The Bank of England initially had the same sort of idea, that these two processes will be separated. Now, obviously, those two things are going to be potentially overlapping, i.e. we could see rate hikes at the same time as QE continuing. And the two things not happening kind of as you would normally expect. And that's now being priced in by the market. And what's interesting, though, Guy, is the jobs perspective of this. You and I have been focused a lot about inflation, given that the Fed has said that they were going to let inflation off to the side while they focus on jobs. Powell saying we're still on
track to taper, but we're still 5 million jobs below a high that we were in 2020. So it's premature to slow down some of those job gains while we taper gets nearer. So you get this sense of that balance of still really needed to focus on that labor market.
Absolutely. If you want to continue to focus on what is being said by these central bankers, you've got Carsten speaking right now with the BIS, but Jay Powell and Seti Kanyango also on the panel with Francine as well. You can do so on your Bloomberg. There is a slight issue with the audio, but nevertheless, definitely worth following along as to what is being said, certainly by the Fed chair. Fascinating, some of the comments that he's making. You can do that on your terminal. Very straightforward. Just punch in live go. You'll see the event. Just click straight into it and you're off and you'll be able to hear what's being said. The supply chain story, though, continues to be absolutely front and center in this earnings season. The CEO of Mattel, he's talking about his company as we work our way up to the holidays, working through supply bottlenecks, Taylor, that are very, very much a story not only for him, but all the way through to the supply chain. He spoke with Bloomberg following the toy makers' earnings beat overnight.
It was another strong quarter for us with continued consumer demand for our products. And, we achieved growth and gained market share for 5 consecutive rows now. We do expect to continue growing for the balance of the year, gain market share, and have a strong holiday season. And it's not that we did not have supply chain issues, but we were able to work through them. We anticipated short supply and longer lead times and factor that into our planning with very specific mitigating actions. And this is really where, our scale, expertise, and flexible supply chain model that we restructured over the last 3 years is playing to our advantage, and we are ready for a strong holiday season.
When you say you're going to have a strong holiday season, how much of the orders were front-loaded because people were scared about these supply chain issues? Are we going to see a little bit of a fade when it comes the fourth quarter and during the fourth quarter that we saw some front-loading already in the third quarter?
We are entering the fourth quarter with great momentum and off to a good start already. We're seeing that consumer demand continues to be strong. Retail orders are strong. Our retail promotional plans are in place. And, we have very exciting range of new product that we're introducing to the market. So, it's always hard to tell exactly about phasing of consumer behaviors. But we very much look forward to a happy holiday season with lots of toys for children to play with.
You did mention that you have managed to successfully reorganize your supply chains, but we've heard from numerous other companies that have had to pay over the odds for space on shipping containers, and getting things moved around has been costing a lot more. Are you having to burden any additional costs because of these issues?
Yes, we did see inflation. We talked about it before. We expected it. It is affecting our profitability. But even with that, we just raised our guidance for full year adjusted EBITDA to be between $900 and $925 million. It's the third raise this year. And we do expect to continue improve profitability and exceed $1 billion of adjusted EBITDA next year.
Inon, you mentioned inflation. How much of the price hikes of the materials prices is being passed to the consumers? Give us a sense of whether consumers will actually have to pay more for your toys.
Well, we already put our pricing action in play. This is part of our third quarter results. We haven't seen impact on consumer behavior, in consumer demand. And I can tell you is that when we raise prices, we always have the consumer in mind, and we always make sure that it is thoughtful, and we balance quality and value for consumers.
That was, of course, Mattel's chairman and CEO, Ynon Kreiz, speaking to Bloomberg's Sherry-Ann and Paul Allen overnight, talking about the supply chain issues, but ultimately the demand story that is so strong. One of the factors that obviously could overshadow the holidays, rising case counts around the world. Germany just recorded its steepest one-day increase in new coronavirus cases since May. We're going to dig into the details of what is happening here in Europe next. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm John Hyland, and you're looking at a live shot of the principal room. Coming up, Sonal Desai, Franklin Templeton Company's Executive Vice President and Fixed Income CIO. That's at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News now. I'm John Hyland. President Biden says he doesn't think there are enough Democratic votes to raise tax rates in a deal on his economic agenda, but he believes he'll get an agreement on the overall legislative package. The president made the comments during a CNN town hall. A White House official says Biden was referring only to corporate tax rate increases, not other potential provisions to raise federal revenue. And authorities are investigating after confirming that actor Alec Baldwin shot 2 people, 1 fatally, in an incident involving a prop gun on the set of a film in New Mexico. The movie cinematographer was killed and the director wounded. A spokesperson for Baldwin described it as an accident. Production on the film has been stopped. And Pfizer says the COVID shot it has developed with BioNTech was nearly 91% effective against symptomatic cases in kids ages 5 to 11. Pfizer released the information in advance of a key hearing scheduled for next Tuesday, where an advisory panel will debate whether the vaccine should be cleared for young children. The U.S. hopes to be able to begin vaccinating that age group before Thanksgiving. And vaccinated travelers from the U.S., U.K., and most of Europe will soon be able to enter Thailand without quarantining. They are among 46 countries, including China, Australia, and Singapore, to be added to the quarantine-free travel list starting next month. Nighttime curfews in 17 provinces, including Bangkok, are also set to be lifted. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm John Hyland. This is Bloomberg. Guy?
John, thank you very much indeed. Let's stick with what is happening with the virus. Germany reporting more than 17,000 coronavirus cases for the first time since May, raising concerns about a winter surge in COVID-19 cases there. Other places, I've just seen the Italian numbers, they're looking much better. Maybe some signs of stabilization within the UK data as well. The United States, we're also hearing from the CDC, running at a relatively stable rate too. It'll be interesting to see, though, as we start to enter the fall, whether or not those numbers start to pick up. Sam Pazzelli of Bloomberg Intelligence with us now to dig into the numbers. Sam, what we've seen, I'm going to start with kind of comparing and contrasting Germany, the UK and Italy. Italy, incredibly tight restrictions still in place. You really struggle to go anywhere without having to show some sort of COVID identification. Masks are still largely being worn. Germany, different case. The UK, very liberal. The UK's cases have shot up. Are we now starting to see some stabilization?
Well, so the UK, if you want to find some positive in the numbers, Guy, is to look at the rate of increase, and that rate of increase is decreasing. Right. Now that is digging, right?
Yeah. No. I'll take any good news at this point.
Yeah, that's right. But so let's hope that stops actually increasing. But by rights, it should do, because we're getting boosters into people, we're vaccinating children, and hopefully they'll do a lot more over the half term. Half term itself should reduce the infection rate. So let's hope that the UK does end up. I mean, 50,000 cases is still quite a lot on a daily basis. But hospitalizations are still below 1,000 a day. One is bad, but it's better not to break through 1,000. Germany is an interesting one, right? Because it's between the two. It's not as liberal as the UK. Some states require passport, vaccine show,
passports,
documents, etc. Some don't. France, Italy, Spain, I think you need your pass to get in and get about. So,
Sam, it's interesting. Here in the U.S., we're getting a mix of boosters. So if you get J&J, you can get Moderna, vice versa. If you don't like what you got, you can get a shot of a different dose or a different manufacturer on the booster. What are you hearing in Europe is going to be the path forward for boosters?
Yeah, so in Europe, we have had very little of Johnson & Johnson vaccine. And over here, therefore, it's either been AstraZeneca or mostly Pfizer. And I think most people are going to get a third shot of Pfizer. In the US, it seems to be, as you rightly said, that the recommendation is you should take the same vaccine for your second if you're J&J, or third if you're Pfizer or Moderna. But the mix and match is allowed, essentially, I think, from what I've understood.
In terms of the impact that vaccinating kids is going to have, how quickly do you think that is going to be felt? I speak as a parent. My eldest son has been vaccinated. He's shown no symptoms for a week, but many of his cohorts are still struggling to find vaccines. How quickly do you think this process will unfold? Do you think it'll be something that we're having to live with here in the UK until Christmas, those high case counts, particularly in that younger group?
I hope not, because they're supposed to change things when it comes to where you can access vaccination for the younger group. You can now go to from whenever, soon.
Yeah, it was just in schools. Now they're broadening
that was crazy, because you almost automatically introduce an artificial block. But now you can go anywhere to get it done. So whoever wants it can just go and book up and do it. I hope that makes a difference. The kids are off school. Hopefully they don't worry about having a side effect or whatever after their doses. So they just go and get it done. That will make a difference. And it's just one dose, right? And we know with one dose you don't really get that much side effects.
What are you hearing about travel then, especially as we come up on the holiday season?
Well, hopefully nothing, because I'm one of those who wants to travel back and forth a little bit. But we did hear, for instance, Morocco did introduce a kind of a block or restriction for UK, I think Dutch, if I'm not wrong, and German travelers, which is to do with the case counts going up in those 3 territories. But honestly, if we keep doing this loop of bringing restrictions and taking them off again, it's just not going to help anybody, and it would just damage confidence in people even booking any travel. I don't think it's healthy.
Is there any concern that what we're seeing here in the UK is a different variant? Epsilon, are we going there? Are we kind of, we're done with Delta, or are we still dealing with Delta here?
Yeah, if there is one place where you know you're going to get information detailed on these variants and subvariants and variants of variants, it is the UK. I checked this morning the data, and it's a nice 100% green, which is Delta.
Sam Pizzelli.
Or subvariants of.
Really appreciate your time there, Sam Pizzelli of Bloomberg Intelligence. Really appreciate it. Guy, want to bring you, more headlines just really coming here from Jay Powell, saying that he's very mindful of our effect on global financial conditions, that their communication on taper, it has worked. Interesting, maybe hinting that there has not been a taper tantrum like the last time we had a taper. Indeed, you see the opposite today. Bonds catching a bid, price higher, yield lower by 6, 7, 8 basis points on 10s and 30s. So saying that they're trying to be as transparent as possible for markets. But indeed, they are monitoring inflation carefully, will adapt accordingly. They will use the tools if they do indeed see serious risk of inflation. They don't see it yet. They do see that it is time to taper, but the risks have tilted clearly to bottlenecks and higher inflation. You can watch all of that. Make sure to tune in on Live Go on your Bloomberg terminal. We'll be back in a minute. This is Bloomberg.
So what are we watching right now? We're watching the US 10-year very, very carefully, tracking lower. 163.60 is kind of where we are now. We're down by around 7 basis points, near session lows when it comes to yields, as you can see on the screen in front of you. This as we track very carefully Francine Lacroix's conversation with Jay Powell that is taking place right now. Just some headlines from that, talking about the impact that Delta has had. As Delta fades, Jay Powell says growth will return to summer high levels. That, in some ways, you could argue is potentially quite a difficult thing to manage, because that's fine if that goes into services, Taylor, but if it continues to drive this hotter economy, more desire for people to purchase stuff, i.e. materials, and continues to have an impact on the energy market, then that could further exacerbate the situation that we see in terms of the supply chain shortages and the inflationary impact that they're having. He is talking about the fact that they are watching carefully for that second round effect, that move from materials inflation, energy inflation, into wage inflation.
I'm confused. I thought we already got that a few months ago, Guy.
Well, yeah, but maybe we're still in the foothills of it. and it's not consistent. But yeah, you are already certainly seeing some evidence of that. But if you get it, I think if you get it embedded.
Time, Guy.
I think. Well, don't give me a hard time. Give Jay Powell. Give Jay Powell a hard time.
I just like to give you a hard time that you're not on Facebook and you don't believe in Bitcoin, or do you? We'll never know. Guy, there's all seriousness. The markets are a big deal. I think what is so interesting to me here, Guy, is that we're taking a look at yields falling across the curve, like you mentioned, but you're seeing technology get hit the hardest. And typically that's a relationship that we don't see. So you're seeing a little bit of a breakdown here in tech, even though yields are falling. Though within the individual sectors, it's financials that are some of the best performers, which you typically see in a higher yielding environment as well. Technology on the bottom, dragging down everything else.
Well, that Snap story, I think, is really fascinating. The fact that this is now bleeding into the social media companies, the advertising companies. As I said at the beginning of the show, if you're GM and you're struggling to sell cars, do you need to advertise the cars that you can't sell? I don't know. We'll wait and see. But ultimately, I think it's going to be a tough story, maybe a tougher story than we anticipated for those ad companies. I'm sure they'll find a way around it. They're pretty smart. We're going to carry on the conversation. Balance of power, obviously continuing to monitor what is happening with Jay Powell. We'll do that on the cable as well. I'm off to Bloomberg Radio. Taylor, great to have you along for the ride today. Thank you very much indeed.
So fun.
This is Bloomberg.